Hi, everyone. Thanks for tuning in to Passport to Wealth, the podcast that takes you on a journey through navigating your finances as a U.S. expat. I'm your host, Arielle Tucker, a certified financial planner and enrolled agent focusing on cross-border planning for U.S. expats. And I'm joined by my co-host.
I'm Savannah Chaffin, a CFP candidate, enrolled agent, and self-declared expat tax nerd, here to guide you through the maze of life and finances across borders and share the inspiring stories of fellow U.S. expats who have navigated the process.
Welcome back, everyone. Today, we are discussing a pretty hot topic at the moment, and that's navigating your finances during election season. So this year is particularly noteworthy as more than half of the world's population from over 60 countries will be casting ballots. With roughly 2 billion people eligible to vote, it's the largest election year in history. The sheer scale of these elections brings added complexity to the financial markets as decisions made at the polls can have far-reaching consequences globally. So this makes it really crucial to maintain a diversified portfolio and to help manage any regional fluctuations.
With all the media attention and market speculation surrounding these elections, it's really natural to feel anxious about your investments. And so that's why today, Savannah and I are going to be diving into some practical strategies to help you stay focused and secure financially during these turbulent times.
So to start off, let's tackle some common myths about the stock market during election years. And first and foremost, there's a myth that stocks don't perform well in election years. So what does the data say about that, Arielle?
Well, the reality is returns in election and non-election years usually aren't that different. For example, the S&P 500 has shown resilience regardless of the political outcomes. And market reaction has more to do with the economic backdrop than the election itself.
I feel like every time there's elections, there's always this doom and gloom, people thinking that markets will drop, the market will crash. So, how do you really think a particular candidate winning kind of impacts a market crash potentially
Yeah.
happening?
We've seen market booms and busts under various administrations. For
Mhm.
example, in the 2020 election occurred amid the COVID-19 pandemic, which had a more significant impact on the markets than the presidential candidate's policies. Similarly, if you look back to 2008 and the financial crisis, it overshadowed any election-related market moves.
Okay.
So elections can create uncertainty in the markets, but history shows us that while volatility is common, it's typically short-lived. To start off, let's discuss why markets tend to be jittery during this time and what it means for you as the investor.
So, elections can lead to potential shifts in policy that might affect various sectors differently. When a new person comes into office, they come out with legislation, and of course, that shifts policy. And when it comes to investors, they often react to these uncertainties with caution, leading to increased market fluctuations. So, you might see people buying or people selling particular stocks, which kind of leads to that fluctuation in the market. However, as an investor, it's important to remember that most of these fluctuations are temporary, and the market really tends to stabilize once election outcomes are more clear.
Yeah, and speaking of market behavior, Savannah, looking back to 1928, stocks have returned an average of 7.5% during election years. That's compared to 8% during non-election years. So although it's maybe slightly weaker, returns are still very solid. But it is very important to note that election years do tend to be much more volatile. Historically, the average election year since 1980 has seen an intra-year drawdown of about 17% versus 13% in non-election years. Yet, as uncertainty dissipates with the election results, stocks often rally, benefiting from a clear path forward.
So
And
what
you might be,
exactly,
I
sorry.
know,
So
you're probably
what is
asking,
intra-year
what is
drawdown?
intra-year drawdown?
Please tell me,
So
Ariel.
it measures the largest drop from the highest point to the lowest point of investment value during the year before it potentially recovers. This metric is often used to assess the volatility and risk within a certain period. So, for example, if a stock market index starts the year at 1,000 points, then it rises 12 to 1,200 points, then falls to 900 and finishes the year at 1,100, the intra-year drawdown would be calculated from the highest point, so the 1,200, to the lowest point, which is 900. This means the intra-year drawdown would be 25% or a 300-point drop. And so it's really important to kind of consider like the intra-year drawdowns, and it helps investors to gauge how much value their investments could potentially lose during a bad phase in a year, and whether they have the risk tolerance to withstand such a drop without selling their positions prematurely. So going back to what we talked about, which is, we have more intra-year drawdowns of about 17% versus 13%. We know that election years, there's going to be more volatility, but that could also mean some opportunities for investors to be entering the market.
Okay, so if I'm following you correctly, intra-year drawdown is basically starting at like the highest point threshold versus the lowest, and that difference is pretty much a measure of volatility. So you can say intra-year drawdown is kind of correlated with the volatility in the market. Would you say that's a correct assumption? Okay.
Yes, great.
Yeah, so with election season, there's inevitably a bunch of up and downs, but kind of what strategies would you recommend to our listeners to manage their anxiety around investing?
Yeah, so I would say first and foremost, it's really important to stay diversified. Don't put all your eggs in one basket, as your grandma would say, especially in sectors that could be heavily impacted. So next, consider setting up a really solid financial plan with clear goals. Like what are we working for? What are we saving for? This plan needs to be robust enough to withstand different market cycles, right? We know over the long run, the market will likely go up, or it has historically always gone up, but that doesn't mean there isn't going to be periods of extreme volatility. Avoid making impulsive decisions based on headlines, right? We want to keep an eye on the news, but please do not let that dictate your financial actions. So again, it's really important to understand also, like, do you first off have your emergency fund in place? And that's generally in cash or like cash. So maybe it's like in a CD if it's not in cash, or a money market fund. You can get to that money really quickly. And when you have that emergency fund, it kind of gives you that piece of, I have this money set aside. If something happens, I can access the cash and I don't have to worry about selling any investments to meet my basic needs. That's kind of our first level of defense, to not feel anxious about market volatility. The second is to really think about, what are my maybe more short-term goals? Maybe we really want to buy a new car this year. Maybe we needed to set $30,000 to $50,000 or francs or euros aside for that purchase. That's a big purchase. And so we want to make sure that that money that we know we're going to need in the next year or two is not in the market, right? We don't want to have a period of extreme volatility and now we have to be selling at that low to fund our lifestyle. So it's really important. And then we have our long-term investments, right? This is money that we don't need years for years. Maybe it's to help fund, college education, or to fund a retirement or a second home purchase. That money can be subject to volatility, right? But it's also important to acknowledge, what is my risk tolerance, right? Am I comfortable with having a lot of volatility with the potential upside? Or do I want to have a more balanced portfolio that I maybe don't get, the highest of high returns, but also I don't experience those massive market drops. I've got that cushion and that balance in my overall portfolio. That's really important, because at the end of the day, the thing that will most likely keep you invested in the long run is how you're sleeping at night, right? We want you to go to sleep and not feel anxious about your portfolio or feel like you have to be checking it every day, because you really shouldn't.
Yeah, I think another good point about like the long-term investments and what we tell clients all the time is it's all about time and market. Yes, there will be lows, there will be highs, but I mean, the goal and the hope and what we've seen in history is that it all kind of even out in the long run. So important to keep in mind. And I wanted to quickly circle back. You mentioned a bit about like currency exchange. If you have like a big purchase, making sure you have money in like the currency. We're kind of seeing this right now. Like the franc is highly appreciated to the US dollar. And that's something else that you can see kind of in these times of volatility.
Yeah, and I think that goes to for US citizens building a life abroad, that does add another layer of complexity to their overall financial plan, right? We have clients who are living abroad and earning in USD still. That is a huge consideration.
That's me.
We have other clients who are living abroad and they're earning in their local currency. That's a different consideration. So you really have to kind of work on matching your expenses to the currency that you're living in. And so it's just kind of important to think about, okay, if we're purchasing a car, which currency are we purchasing that in? And as we plan for that purchase, if all of our savings and wealth is in USD, in the US dollar, we need to bring that over and put it into the local currency, or we need to take a pause on sending money that we're investing in the dollar in the US markets, and we need to kind of build up our savings in our local currency, just to kind of help cushion any of those, like we suddenly need to move over, $50,000 and oh man, like the currency rate isn't that great right now. Yeah, that's definitely another risk that US citizens have to to kind of navigate in their overall plan.
So at the end of the day, elections will bring uncertainty, but your approach to investing doesn't have to waver. The whole opinion, if X is elected, I'm going to sell, 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 or buy, buy, buy. Avoid that is our suggestion. But yeah, stay informed, stay calm, and keep your financial goals in a clear view.
Thank you for tuning in. Stay tuned for our upcoming episodes packed with insights and stories to empower your global financial journey. This is Passport to Wealth, where your financial future knows no borders.
The information provided in this podcast is for informational and entertainment purposes only. It should not be considered professional, financial, or tax advice.
We strongly recommend consulting with a qualified financial advisor, tax professional, or other appropriate expert before making any financial decisions or taking action based on the content discussed in this episode.
Your personal financial situation is unique, and a professional can provide tailored advice to meet your specific needs.